I think 2023 is a great year to start saving or investing for the down payment on your first house or your first rental property. Let me tell you why. The rule of thumb I follow when it comes to saving versus investing a big amount of cash is time. If I'm going to buy a house within the next 3 years, I'm going to keep my money in a high yield savings account or a CD. If I'm not looking to buy a house or a rental property within the next 3 years, then I'm going to invest that money in an index fund. It's all about the risk reward at that point. And I would fully take advantage of the Federal Reserve's high interest rates by saving the money I need towards the down payment on my first house or my first rental property. And the high interest economy might not last long if inflation starts to cool down faster than expected. Now, I understand that the mortgage rates are a lot higher than they were in 2020 or 2021. The Federal Reserve has already indicated that they will continue to raise interest rates to bring inflation back down to the 2% target rate. And the CPI report that was released a few weeks ago still showed a 6.4% year-over-year increase, which is still behind the Federal Reserve's target rate. With the Fed funds rate remaining at 4.9 to 5.6%, the mortgage rates will likely remain between 6 and 7%, and that's according to my own assessment. At the time I'm recording this video, the 30-year fixed rate mortgage rate is at about 7%, which has climbed back up from 6.5% a few weeks ago when I made a video about the housing market. And if you look at the summary of economic projections, the Fed is looking to increase the interest rates by 25 basis points for 2 more FOMC meetings. Now, the market is talking about the Fed possibly raising that to 50 basis points at the next meeting based on the most recent CPI reading. It was not a good CPI report at all, and I did a live stream on the release when it came out back on February 14th. We're probably not gonna see any rate decrease until late 2024 if the inflation rate remains where it is now. The next CPI report will come out on March 14th, which is exactly a week before the next FOMC meeting. If the report comes out hotter than expected, then I wouldn't be surprised if the Fed raises more interest rates, which will increase the mortgage rates for the foreseeable future. We'll see. But let's forget about the mortgage rates for now. I know that's on a lot of your minds. And if you're looking to buy your first home, you want to think of it as a long-term asset that you're going to hold for a long time. You're probably not gonna buy a house next year and then sell it the year after, right? And I want you to take advantage of the high interest rate economy by saving your money in a high yield savings account or CD if you're looking to purchase a home within the next 3 years. Let's first talk about high yield CDs. I personally have Ally Bank, and this video is not sponsored by Ally Bank. And I've been with the bank for several years now, and I absolutely love the service they provide. When I look at the rates for their CDs today, I noticed that they were offering 5% APY or annual percentage yield for the next 18 months. It doesn't even need to be with Ally Bank. You can find several banks that offer high APYs because of the Fed funds rate in the current economic status. And I'm just gonna show you this high yield CD. For example, if you don't know what a CD is, it stands for a certificate of deposit. And Ally Bank is FDIC insured up to $250,000 per depositor. You wanna make sure you find a bank that has FDIC insurance because you don't wanna risk putting your money in a bank without one. If you remember what happened in 2008 and 2009, so many banks failed, and the ones without FDIC insurance cost people tens of thousands of dollars. And they don't charge any maintenance fees for your CDs. And when your CDs mature, you can withdraw your money at no charge during a 10-day grace period. And you have to keep in mind that there are early withdrawal penalties if you don't carefully read the fine print. You also need to make sure that the down payment towards your house is separate from other cash savings like your travel fund, emergency fund, or annual expenses fund. They also offer no penalty CDs, which allow you to take money out without any penalty. It still offers 4% APY, even if it's not 5%, it's still a significant interest rate compared to what I've seen in the past. And again, you can withdraw your full balance and interest anytime after the first 6 days following the date you funded the account. And I know I sound like a salesman, but I promise you, I am not selling you anything, and I don't even get a commission for recommending Ally Bank. It's just a bank that I use and really like. And when you look for a CD, make sure that there are no fees to open or maintain a CD. Some banks do charge a percentage of your savings, and you probably don't want that. Second, you want to find out if there is a minimum deposit to open a CD. You normally get a higher rate if you deposit more money with a bank. And third, you should be aware that most CDs don't allow you to add additional funds once you make the deposit. Ally Bank does allow you to schedule a transfer up to 1 year before the maturity date. Once the fund matures, you have the option to make a full withdrawal during the 10-day grace period. The only time I would use a CD is if I had a large amount of cash that I want to put away for the next 18 to 36 months to grow 4 or 5% annually. If I had $30,000 saved towards the down payment on my first home, that's $1,500 in interest I could earn with a 5% APY. If I keep the money in the CD for the next 3 years, I could make another $1,575 in year 2 and $1,653 in year 3. That's a total of $4,728 in interest that could accrue for the next 3 years. And don't forget to download my financial independence resources, including all the spreadsheets that I just showed you, for absolutely free by visiting firesightchat.com/contact. You should also check out my Fireside Chat shop to check out the books and equipment I use at firesightchat.com/shopping. But let's just say I don't have $30,000 saved, and my goal is to start from $0 and get to $30,000. The other option would be to open a high yield savings account. The APY for an Ally Bank high yield savings account is 3.4%. This is still significantly higher than my Chase savings account, yielding 0.01%, or your Bank of America savings account yielding 0.02%, right? And I was wondering the other day why JP Morgan Chase, the biggest bank in the world, doesn't offer a high yield savings account. That's because their business is focusing on investment products and services. They'll make a lot more money from management and brokerage expenses. So anyway, assuming the rates don't change at all at 3.4%, which is highly unlikely, but just for the sake of my argument, I'm going to use 3.4% at today's rate as an example. And if I deposit $500 every 2 weeks into my high yield savings account, by the end of the first year, I'll have $13,200 saved. Even though it's yielding 3.4%, I'll only make 1.66% because the beginning balance was $0. So don't be alarmed when you make less interest than you see on paper. Anyway, because if you take a look at year 2, I'll have almost $27,000 saved with a 2.56% effective APY, which is a lot higher than year 1 because I had a beginning balance of $13,000. That makes sense so far, right? And these APY or interest are paid once a month or usually in the first week of the month, depending on the bank. By the end of year 3, I'll have more than $41,000 saved with an effective APY of 2.87%. Again, this is assuming that my high yield savings account is still yielding at 3.4% in year 3. I don't just talk out of my butt about these numbers. I like to demonstrate them to you on videos like this or during the live stream. By the way, I just launched a new live stream program on my channel, which includes live Q&As and group coaching sessions about the FIRE movement, stock market, real estate, and any current events in the world. With the private membership program, you'll have access to my private Facebook group and group coaching sessions to discuss your financial independence journey. You can check out my YouTube channel for more information about the private membership program. You can also schedule a free one-on-one 20-minute financial coaching session by visiting firesightchat.com/coaching to discuss your personal finances. And lastly, if I'm not looking to purchase a house or a rental property for more than 3 years, I'm gonna park my money with an index fund in a taxable brokerage account and not in my retirement account. The goal is to make my money grow a lot more in the next 3 to 10 years, depending on when I want to purchase my next home. Now I'm gonna pull up VT-SAX or the Vanguard Total Stock Market Index Fund as an example. And 2022 was a terrible year to invest with the Fed raising interest rates, rising inflation, and people were just scared out of their minds, right? And if I were to buy a house within a year and I parked my money with this index fund, I would have lost 9% in the value of this portfolio. And that wouldn't be smart of me to do, especially when I'm looking to use it within the next 3 years. But I'd be more confident in parking my money with the index fund for the next 3 to 5 years with the potential to grow more than 7% annually. After the market downturn in 2022, the S&P 500 in January alone gained 6%. Again, that was just in the month of January. And VT-SAX has performed over 7% in return year to date. Now, I don't know how the market will do for the rest of the year, but I'm more confident in the market if I were to park my money for at least 3 years and hopefully not lose too much on inflation, right? And I'm not saying that VT Sachs is the only index fund I'm going to choose to invest in the down payment of my next home. There are several funds that are, in my opinion, trading at a discount. If I'm not comfortable with the stock market, I can always park my money with CDs or high yield savings accounts that will pay me 3.5 or 5% in APY. At least I'll get that interest without dealing with the stress of market volatility, right? The bottom line is that you want the money to work for you by taking advantage of the high interest economy. While the mortgage rates are high, I would use the higher APY to save more money towards the down payment to decrease the monthly mortgage payment. Home buyers' purchasing power dropped when mortgage rates rose above 6% and now it's 7%. If you could reduce your mortgage payment, let's say from $2,500 a month to $2,000 a month by making 5% in savings interest every year, you would do it, right? But before you start saving for a house, I recommend that you have a fully funded emergency fund in place and your high interest debt completely paid off. You want to maximize your savings rate by not having any student loans, car loans, personal loans, or credit cards before saving for a house or buying a house. Trust me, I made that same exact mistake back in 2014 when I purchased a house when I still had over $110,000 in consumer debt. And if I could do it again, I would be debt free first before adding major housing expenses. And if you want to know more about how to save and invest in your financial independence, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe and I hope to see you in the next video. Have a good one.